And now for our regular Friday night chat on economic issues. We're joined in the studio by economics correspondent Stephen Long. G'day, Stephen. Now, some economic figures have come out from China and they show quite a fall in growth and industrial output. What's behind that?
Emma, there's two factors behind that fall. 8.1% growth, it's still stellar by our standards.
By anyone's standard.
Yeah, but a lot of economists consider 7.5% growth in an emerging economy like China would be akin to a recession. And it is a big slowdown, sized in 3 years. Two factors, I think. One is Europe collapsing into recession, hitting the export markets for China, and the other is the legacy of the credit controls and tightening of interest rates that they put in place last year, the Chinese authorities, when they were worried about asset price bubbles and a possible overheating in the economy leading to disaster. So they're rapidly trying to unwind that right now.
And so what are the implications for Australia, given we are economically so inextricably linked with China at the moment?
We've already seen commodity prices fall. The danger for Australia is that if China is indeed on a slowdown, that's going to hit us very hard. We're in lockstep with China. They're a huge market for our commodities exports. It would hit us on so many fronts, Emma. The budget, because we're relying on the revenues from the miners and the commodities boom to keep the economy going and bring in the tax receipts. But also we've got $315 billion in the investment pipeline due to go into mining projects in this country, and all that is premised on expansion in China and strong economic growth in China, buoying up demand for minerals. So it's really bad news for us if it continues. Now, the Chinese government at the moment is loosening up the loans to try to get domestic demand going, but the question is really whether they can do that. There's a lot more debt in China than people realise. The banks are heavily indebted and riddled with bad debts, and even at a national level in China, if they want to throw in a bit of stimulus, they say they've got 17% debt to GDP, but they exclude from that measures about all the state-owned enterprises, the railways and various other utilities that really should come in. You put that in, they've got 70% public debt to GDP ratio, bad debts. There are worries, but we don't know whether they can engineer the growth path again short term.
OK, well, if we can just move domestically for a moment and look at ANZ's decision today to buck the trend and lift interest rates at a time especially curious given the Reserve Bank has signalled that its next move is most likely in the next month or so to be down.
Well, I guess the issue here is that the Reserve Bank's interest rate policy really doesn't have a lot to do with the costs at which banks fund at now, because prior to the GFC for many years, the interest rate set by the Reserve Bank ran in pretty much in lockstep with most of the funding that the banks got. That's no longer the case. Pretty cheeky by ANZ though, and I guess the question is, will the market tolerate it? And the answer so far has been yes. People don't leave the majors despite the fact that they will push rates as far as the market will permit them.
OK, Stephen Long, thank you very much.
You're welcome.